There's Brian Jacobsen, Allspring Global Investments Senior Investment Strategist. Brian, we certainly saw the reaction in the markets this afternoon. Apple announcing that hiring news, the fact that they are going to be pulling back on hiring. The market's a little bit concerned about that. What do you think?
Yeah, I guess it goes to show that the old saying is true about a bad apple can ruin the whole bunch. So a little bad Apple news can ruin the whole market here, or at least push it a little bit into the red. But I agree that there's a bit of optimism and also a little bit of pessimism here, right? You can have almost self-fulfilling prophecies where if businesses are getting pessimistic, where they're cutting back hiring or capital expenditures, that can actually fuel a downward spin for the economy. So perhaps a little bit of a mild recession. But right now, it's maybe a little bit early to say that this is really systemic, where it's representative of how all businesses are going to behave in the upcoming environment. There's got to be some optimism out there. And if anything, it seems to us here at Allspring that the market has already priced in pretty decent amount of pessimism, pretty high probability that we're in or going into a recession. So maybe now is the time to look for companies that can play offense while everybody else is playing defense.
And so who do you recommend in that regard? Who's playing offense right now?
Yeah, so we work with a number of teams on our fundamental equity side and on our fixed income team. I'm more of the macro strategist, so I can't talk about individual companies, but one of the areas that my team that we really do like is in the consumer staples side and in the technology side. So it's almost like a barbell approach here where there are a number of names that seem that they probably got thrown out or thrown under the bus, so to speak, as people got a little bit more pessimistic, thinking that what the Fed might do might induce a recession as they try to tame inflation. But I think that there are a number of good opportunities if you look within each one of the sectors. So my team, we're overweight in more of the defensive areas right now, but we are finding some opportunities in some of those more cyclical areas like technology even.
And when you look, Brian, at the bank earnings, and again, there's a wide range of outcomes and earnings in the last week or 10 days. If there's one common theme, is it a slowing in the investment banking sector? And what does that mean for the broader economy?
Yeah, so when you look at investment banking, a lot of that is driven by current market conditions. People don't want to issue equities when price to earnings, when those valuations are coming down. They'd rather maybe take a little bit of a pause and wait for it. So some of the weakness in investment banking, that might just be indicative of better earnings, say, next quarter, if the equity market does find a bottom in this area and starts to recover. So I'm really not that worried about the signal from the investment banking side. It's more the commercial banking side that we like to look at. What's happening with loan growth, default rates. And on that front, it seems like things are, the banks are increasing their loan loss reserves just in case, but things are looking pretty decent on that front.
So, Brian, what does all this mean then for Fed policy? There was talk last week about a 100 basis point hike. Now it looks like it's more likely that we'll see a 75 point hike next week. What do you think the Fed should be doing at this point?
I think that they should take it nice and slow and actually just try to communicate with the public that there's only so much that they can do, especially for near-term inflation relief. If there's one lesson from history, it's that if the Fed wants to tame inflation really quickly, the only way that they can do that is by taking rather extreme moves. It would be like, instead of 75 basis points, how about 750, right? I mean, it would have to be some sort of shock and awe thing that would be economically devastating. So I don't think they'd like the collateral damage. Really, monetary policy is about playing the long game. So they need to, I think, communicate to the public a little bit better about what to expect with inflation as a result of monetary policy. So if they take it nice and slow, 75 basis points next week, then they can maybe try 50 basis points and then throttle it back to 25. So it's more about that long game that can bring longer term inflation back under control. But short term, it is unfortunately really driven by things outside of the Fed's control. Food costs and fuel costs, the Fed can't do much about that.
So, Brian, as you mentioned, there's some things outside of the Fed's control. What are some of the indicators that you're watching that's really giving you an idea about the health of the economy?
Yeah, some of the near-term indicators, I mean, the stock market itself is a really good barometer, but it can be very fickle as well. Looking at the short end of the yield curve, we like looking at that as far as the difference in yield between, say, a 2-year and 3-month tells you something about what the market's expecting for the Fed to do. But then looking at those longer-term yields, a 10-year Treasury yield at around 3% is probably pretty close to fair value. We think it could probably get to 3.5% by the end of this year as people redevelop a little bit more optimism as we get through this short-term pessimism. The home builders sentiment survey was not very encouraging, so we'll have to see if that gets a little bit of a rebound. But those are probably some of the big indicators, right? What's going on with housing, with home builder sentiment, and then what's the market telling us? And right now, it seems like the market's trying to find a bottom, trying to find a reason for optimism here. And maybe as we get through earnings season and we learn that businesses can be resilient despite some of the headwinds that we're facing, that can rekindle some of those animal spirits.
We'll talk a lot more about the real estate sector in just a minute. But Brian, what about the consumer? I mean, we know the consumer sentiment last week came in at a bleak number of 51. But report after report shows the consumer continuing to spend in the face of inflation, the highest we've seen since 1981.
Yeah, so here on my team, the Systematic Edge multi-asset team, we had that discussion after the report came out, and it was a really important report because that report was one that Chair Powell had pointed to as far as justifying their previous move, right, the inflation expectations. Well, thankfully, that number came down. That's very highly correlated with gasoline prices, so it shouldn't have been too much as a surprise. But people are rather pessimistic about current conditions and the outlook. Now, what matters is not what people say, but what they do, right? And those retail sales numbers are actually hanging in there pretty well. We did have a negative month in May, then it rebounded in June, and we think that we can hold on to some of those gains as we get through these summer months here. So consumers, thankfully, are still employed. Those wages are rising, not as quickly as inflation, but it should be enough where if we do avoid a recession, it's probably going to be on the back of the strength of the consumer and not necessarily on the back of businesses.
Indeed. Allspring's Brian Jacobsen, thanks so much for being with us. Appreciate that.